Get Rich Slow with John Wolf. Hey, today I want to talk to you about the question I often get is how much house can I afford? And while to answer this question for you, I'm going to have to talk to you property, income, assets, credit about all of the main factors, and we're going to go over it. But I'd like to give people some general advice, both what I recommend and what's allowed in the lending industry and with the different program rules. So first of all, I just want you to know I am going to be assuming that someone is capable of putting 5% down and that these are people who are not capable of putting more than 20% down. I'm also going to be assuming that you at least have decent credit, nothing giant to clean up on that end, and that you have a job that is somewhat stable. And job stability comes from two forms. The reliability of the job itself. So, the most stable job in the world is working for some kind of government department that's not going to go anywhere. And the other place that stability goes is from your own ability to jump from opportunity to opportunity when you need to. Anyways, how much home can you afford? So the sort of minimum yearly income for an individual or a household to be shopping for a home in the Portland metro area really is about $60,000 a year. More is better, more is going to make things easier, and yes, less may be technically possible, but the options are going to be very limited and it's going to be a turbulent ride. Now, if you want to go for it, I'll walk that path with you. But I will not be able to promise you smooth sailing, nor should you expect it. But anyways, when we talk about income, let's talk about what goes into the house payment really quick. So I'm talking about the full PITI payment. That is principal, interest, taxes, and insurance. Also mortgage insurance if that applies. So that's the full house payment. It doesn't include like your electric bills and stuff like that, but it's the house payment itself. And for the income, I'm going to use your gross yearly income. So for somebody who's making in the upper income brackets, I am well aware that if your W-2 says you make $400,000 a year, you really take home something like $200,000. But all of the debt to income math for home lending is gross pre-tax income. So that's just what I have in my head. So that's how I'm going to move forward. Okay, so it does matter where you are in life as well. But the maximum debt to income ratio, and that's the house plus all of your other debts, that is often accepted by any loan program is the VA, and it will often accept 60% debt to income ratio or higher. Now, I think that's a little crazy, and it'll even let you do up to 60% on just the house if that's your only debt. And again, I think that's kind of crazy because that's 60% debt to income ratio before taxes. I figure after you pay taxes on your income, that's probably all the money you got. But whatever, I don't make these rules. So what's more common? So FHA lets your total debt to income for the house be 46% and the house plus everything else be 56 maximums again. For conventional or conforming, now it allows both numbers to go up to 50 but not hit 50, so it has to be something that rounds to 49%, but much more commonly the house itself has to be under 45, and ideally all of your debts have to be under 45. Now the last loan program that I'm going to mention here is USDA. Now USDA has a squishy line, but it is 39% for the house and 43% for the all of your debts put together maximum or towards the maximum end. So anyways, what's actually practical and what you should be doing? Well, if you are a single breadwinner of a household and you have an upward sloping income, I don't think you should be afraid of going all the way up to 39% or even 45%. If you are a dual income household, like husband and wife, and you're both working, then you might really want to think about, if you're combining those numbers, keeping it down in the 39% or lower. And if you are in a kind of job that, only gets 1, 2, 3% raises a year, and that's really going to be it for you, and you're fine with that, then you should also err on the side of caution of not getting the whole 45, but picking a lower number. I am quite aware that Dave Ramsey talks about 25% of the income. I think that if you can do that, that would be great. I do think that he's telling the vast majority of, people in the Portland metro area, I don't know about Americans, that they should just basically never own a home. And I do think that home ownership is that powerful escalator to more wealth. And if you don't get on, then you're just going to get left behind. And I think that's bigger deal than hitting that perfect number, if that makes sense. Especially the way things have been going historically in general, it's pretty hard to lose as long as you do actually properly qualify for a home loan. And in the last several years in particular, if you bought a house, any time in the last 10 years, and even if you lost your job and are on mortgage forbearance right now, in the Portland metro anyways, you have a huge positive equity on that home, and you're going to have to decide what to do. But short sale isn't going to happen because you almost certainly owe less on the home than the home is worth. There's going to be positive when you sell it, and foreclosure shouldn't be an option for the same reason. Anyways, if you have any questions for me, reach out, John Wolf at htlenders.com, 503-890-1919. If you like this video, please smash that like button, subscribe. If you hated this video, hit the dislike button twice. That's how you do it. Have an awesome day.